But if we look at the 2025 environment, it's a great setup because we have a new administration coming in that's maybe pro-animal spirits, a Trump put. We have a dovish Fed, and as you're pointing out, interest rates are kind of calming down after rising. And we know there's still $7 trillion of cash on the sidelines, and I think sentiment's coming back into check. You mentioned that before with the AAII numbers. So I think it's a good setup for investors. I wouldn't be too worried about the next 12 months.
Tom Lee of Fundstrat remains optimistic about the investment outlook for next year, citing easing inflation, a dovish Federal Reserve, and strong cash reserves as key positive. He highlights the potential impact of a new administration fostering investor confidence and notes a shift towards cyclical stocks and small caps, which he expects to perform well as economic conditions stabilize. Lee emphasizes that U.S. equities remain the best investment option, despite mixed sentiment among investors about focusing on tech giants versus other sectors. While acknowledging potential market pullbacks, he believes favorable monetary policy and easing geopolitical risks will sustain the bull market into the new year.
So we can stack up all the positives. I mean, I know you've been kind of in gear with that idea that the economy would power through, inflation would come down, the Fed could become friendlier, earnings are going higher. Big question to me is how do we set expectations for the year to come, given that that's all in the books?
It's a great question because, we have two back-to-back 20% years, and now investors are wondering how much good news is baked in.
Let's bring in Ed Yardeni this morning, talking more about the markets. Of course, Yardeni Research President. Ed, happy Black Friday. Great to have you.
Thank you.
You've been writing a lot, obviously, lately about the coming year and actually the next few years. I know we've talked a lot about your 7K target, your 10K target down the road. Right. To Sarah's point about the market broadening, is that, I guess, healthy on a net basis?
Absolutely. You remember when this bull market got started, it was kind of like the Rodney Dangerfield bull markets. It got no respect because it was so narrow. And we argue that give it some time, it'll broaden, and that's what it's doing now. And we've certainly seen the mid caps go on fire, and then the S&P 493, I think, are going to do well, increasingly well.
What do you think's going on with these yields? Are bond vigilantes convinced that there will be constructive work done in this administration?
Yeah, absolutely. I think the Trump administration, incoming administration, bought some time, kind of placated the bond vigilantes by basically acknowledging that we've got a problem with the deficit, and the new incoming Treasury Secretary is somebody who's got a lot of market experience. So he's kind of like one of us, if you will, when the market looks at this administration. And the fact that they're, in fact, going to go after spending and that they're going to try to raise some revenues, maybe with an across-the-board tariffs, at least shows that they're cognizant of the problem. And maybe they're kind of having a Bill Clinton moment. Remember when Bill Clinton was warned by his advisors, don't mess with the bond vigilantes. And we actually had a very conservative fiscal policy back then.
Well, I mean, analogs to the mid-90s are pretty positive, and there has been some work done looking at what happens when you bring the budget deficit relative to GDP lower. It's an everything rally, is it not?
It becomes an everything rally, and the only risk is that it becomes too much of a good thing, that it becomes a melt-up. And we're kind of on the edge there, right? We've got the valuation multiples, which are quite elevated. We've got the forward PE around 22. We've got the Buffett ratio around 2.8, which is a record high. We've got Warren Buffett himself raising a lot of cash, which kind of has everybody somewhat concerned. But all in all, I think the bull market is still very much here and continues into the next year. And I don't see a recession. Recessions are usually caused by credit crunches, and that's not happening with the Fed inclined to lower interest rates. It's not happening with the price of oil unable to have a rally with geopolitical risks, which seem to be actually narrowing. So the only thing left to worry about, I think, is tariffs. And right now, it looks like they are being effectively used for negotiating purposes.
I mean, there's been so many flows into U.S. equities because of all these reasons we're talking about. EPFR reported $141 billion into U.S. equities.
Huge.
And that's for the month, the heaviest inflows in a 4-week period on record. So do you want to just continue that trend, or do you want to go somewhere contrarian like Europe, where everybody hates right now?
Well, you're asking the wrong person. I've been recommending stay home versus go global since 2010. I've been recommending overweighting the U.S. and it's been on fire recently. But you're right, from a contrarian perspective, maybe it's worthwhile looking overseas a little bit. But no, I'm going to recommend continuing to stay home and invest. By the way, I don't like what you just said, because that's talk about contrary indicators. When foreigners really discover the U.S., that can be a contrary indicator. But that doesn't necessarily mean you want to go overseas. So, look, I'm not ruling out the possibility that we'll have some sort of pullback. I think it's Mike Santoli's favorite phrase. I like it better than corrections and bear market. So we could have a pullback, obviously, maybe in the new year. But right now, we're still got a Santa Claus rally, in my opinion.
Final trade time, Steve.
Bitcoin or BTC, grayscale middies, any way you want to play it, play it.
Karen.
You know I'm a long-term investor, so I like Boeing during the E block. We're now in the G block. I still like it. Boeing, happy Thanksgiving, everyone.
Guy.
Yeah, I'm thankful for my family who tolerates me. They're watching now for the first time in a long time. And I'm obviously thankful for all you and
They're not watching
fan base.
anymore.
Alec Bob is picking up some steam here.
So don't be too worried. I mean, it seems as if there are all these supportive factors. And when you mentioned the 20% up years in a row, history says actually, the following year is up more often than not as well. What do you think specifically by the new administration being pro-animal spirits? First of all, it's true.
Yeah.
You've kind of seen it at work. It seems to pull in that direction. But are there specifics that the market is fixated on that it's going to drive that dynamic?
Yes, I think that the market's trying to figure out exactly how this animal spirits plays out in markets, but I would say we've got a Treasury Secretary that equity markets approve of. We do know that the last Trump presidency cared very much about what stock prices do, and Jeremy Siegel said this is the most stock market focused president ever. And I think that the uncertainty is around trade and the potential risks around tariffs, but we'll have to see. I mean, that's something markets are going to have to deal with it from an uncertainty perspective.
It's interesting to me that, the way the market has behaved in the last several weeks, but even going into the election, was we need to own more cyclicals. We need to own more financial stocks. We're going to reprice this market for maybe a growth acceleration even, or at least maintaining above trend growth. Meanwhile, though, we're only a couple months removed from a pretty big growth scare. Job growth has kind of slowed to a point. The housing market seems pretty locked up. It's kind of interesting how the sentiment has kind of jumped ahead. Is the economic numbers positioned to actually validate that view?
Markets tend to be forward-looking, so I would expect this. I know there has been a recession in durable goods and in housing and auto sales, principally because of high rates, which have made affordability an issue. That's really on the come next year. I mean, I think the spread of 10 years and mortgages should come down, and the 10-year hopefully behaves. And I think if there's more confidence and more supply, I think housing actually could lead this recovery. I mean, I think that's why home builders actually started to act better this week as well.
Yes, they seem very sensitive too to yields, sort of halting their rise as well. I guess the question is, if we believe it's still a supportive environment, then pretty much all the things you can identify would suggest you shouldn't be too worried about next year. The second question is something like the S&P 500 the best vehicle to capitalize on that?
I think investors are still trying to figure this out. We did a survey with our institutional investors and our RIA clients last week. The majority of institutional investors don't think FANG is the leading trade. They're actually betting on cyclicals. But if you look at the RIA world, the majority are betting on FANG. So I think the market is still undecided whether to be long the Mag 7 or the cyclicals. I'm inclined to be more cyclical and bet even on small caps having a very big year next year.
Yeah.
Tom Lee of Fundstrat is optimistic about the investment outlook for the coming year, citing easing inflation, a dovish Federal Reserve, and a market-friendly administration as key factors. He emphasizes opportunities in cyclical stocks and small caps, while highlighting strong cash positions and improving sentiment as supportive for continued market growth. Despite potential minor pullbacks, Lee remains confident in the bull market, pointing to stable monetary policies and diminishing geopolitical risk. He encourages investors to consider whether to stay focused on U.S. equities or explore undervalued international markets like Europe. Will cyclical stocks and small caps outperform tech giants next year? How might the new administration's policies influence your investment decisions?